And we are live. What's going on, guys? It's Ricky with TechBud Solutions. Hope that you guys are all having a great start to your Wednesday. Today's September 17th in Arizona. It's 10:46 in the morning, and we are live for the Fomc rate decision today. So in about 14 minutes from right now, we're going to experience the rate decision, and the markets are going to react based off of what is expected and what is reported. On top of that, 30 minutes after, there's an Fomc press conference. This is where Jerome Powell goes live and he answers analyst questions. In my opinion, this is probably the most crucial time where, based off of what he says and how he says it, if it's hawkish or dovish, meaning if he is looking to be aggressive in cutting rates or still be cautious in cutting rates, will determine if markets continue to rally or if they begin to retrace. I want to remind you that the markets and the way that they react from the rate decision can be different from the way that they react during the press conference. It's a very volatile time to be trading, especially if you're a complete beginner. So this is just an encouragement that if you are a beginner, do not be afraid to sit back, relax, and just watch. Let's go ahead and start sharing our screen so you guys can see exactly what it is that we're looking at as of right now. Right now I was looking at Tesla. I closed out my short right before this little live session, so you can see I have my one lucky share available. And that's really just it. So I'll even close out that one. So just even the one share, it's actually a long. So buy to cover. Sell to close. So fully closed out, no open position on Tesla. I also closed it out when it came down to my position on HIMS. Just so you can see here, I made the $1,600. Going to fully close this one out with my one lucky share. Buy to cover, fully closed out, and that is pretty much it. So I was looking at open. I do have an open position on open as of right now. It's a very small position, unfortunately, because they do not have many shares available to short. It's an incredibly volatile stock right now, and I think it's just it's an HTB, so hard to borrow on the platform that I use, but just wanted to keep you guys up to date when it comes down to this move. It's up an additional 18%. It's a full-on momentum-based stock. It's not fundamentals. It's just a lot of momentum driving the price up even more. It could run up to $11 per share. So if you're a beginner, I would not encourage you to short this one. The trend is your friend. I want to respect that. This is a bullish stock, so please be aware of that, okay? All right, where does the market currently sit? So before the report comes out, let me go ahead and make sure that we are all good here. Can you guys hear me and see me okay? Everything is good here? What's up? What's up? So let's do a poll. Let's do a poll based off of who believes what. Okay, the poll, I want to remind you, it's just people's opinion. No one knows exactly what's going to be reported. Right now, NASDAQ market looks like it was de-risking itself right before the report. In about 10 minutes, the report should come out. And remember, I just want to show you everything it is that I believe you should know. The rate decision, the expectation is a 25 basis point rate cut. That's what the market supposedly, according to investing.com, is expecting. Right now, we're at 4.5%. We expect to be at 4.25%. If you look at the Fed rate monitor tool, let me just make sure that it's fully up to date. In 10 minutes, 97.3% probability, according to the Fed rate monitor tool. And this is where we currently sit, 4.5%. We expect to be at 4.25% after the rate decision. So a 25 basis point rate cut. This will be the first rate cut in 2025. And remember, the reason the Fed was so cautious about this was because of tariffs. Tariffs began to get implemented, and as they were implemented, tariffs tend to be inflationary. So now it's hard to ignore that the labor market is beginning to slow down, but inflation is beginning to rise. This is what we call stagflation, but that's kind of getting more into it. So I don't want to get into all of that right now. I think right now it's best to keep it simple. We have a rate cut that is highly expected and anticipated. We'll see how the markets react. And we'll see, most importantly for me, my biggest takeaway is I want to understand how hawkish or how dovish the Federal Reserve plans to be on up and coming meetings, right? Because that's kind of where the guidance, when the earning reports come out, there's the report and then there's the guidance. I think the guidance that we can be given during this press conference will give us a better understanding if we have more rate cuts to expect in the up and coming months, or if they're going to be more cautious and still take it meeting by meeting, which wouldn't really surprise me. That's always what Jerome Powell tends to say anyways. We got PLTR dropping 3%, a nice retracement to lows of 163, but it looks like it's beginning to find its support. I want to remind you, markets are more bullish than they are bearish. They've been finding and looking for any reason to rally. So if you are shorting the market, please be careful. There's never a bad time to take profits, especially during a very volatile time. Okay, let's run a poll real quick. I'm going to run a poll here. How do I do this? Okay. Let me run a poll for you guys, and then you guys can vote. I think we all kind of understand that we expect a 25 basis point rate cut, but I think the difference can be is, do you think it's factored in? So do you think that this is a buy the rumor, sell the news? So after rate cut, how will markets react? And then you can share your thoughts, okay? Bullish, bearish, start poll. All right, feel free to vote. And there we go. Already made my money. I like that. Happy to hear that you're doing your part in taking profits. It's 100% priced in. All right, there we go. There we go. Okay. There will be no rate cut is what James is saying. That's a crazy one. A little crazy. Just a little bit. Markets are holding very well. How do we feel about Tesla? Where are all my Tesla investors right now? Do you think that Tesla is a good deal at $420 per share? I want to remind you, the reason Tesla began to skyrocket from highs of 350 to 430 is because Elon purchased another $1 billion worth of Tesla, therefore artificially pumping the stock price itself. If you look at Tesla and you look at its most recent earnings, let's refresh this. This is Investing Pro. You can see that there's 33% downside based off of analyst price targets. You can see that it's trading at a PE ratio of 237 times its earnings. And if you go to the Tesla Pro research, which for me, this is super useful to have in mind, you can actually perform a fundamental analysis to actually understand the way that Tesla is trading. The part that really surprises me about all of this is that people often say, well, Ricky, you're not understanding. Tesla, it's not just the car company. Well, no shit, Sherlock, right? Tesla would not be trading at a $1.3 trillion market cap if it was just the car company. But guess what? It's just a car company right now. And its car business, its core business, is no longer growing. That is the concern that I've been expressing. Look at its revenue for its past quarters. Does this look like a growing company? And I want to remind you, it's about to lose its EV regulatory credits, which amounts to about 30 to 40% of its net profit on a yearly basis. So imagine that. You're about to lose the leverage of 30 to 40% of your net profits. You're about to lose the incentive of the $7,500 tax credit so consumers can purchase your vehicle. And now it's during a time where your revenue is already beginning to decline. And you would only know this if you've actually taken time to look into their financials. That it's not just a matter of opinion on what you believe, but you actually look at the numbers. I think it's super, super important to just be well informed. If you still look at all of this and you still believe that Tesla is a good investment, great. At least you're aware. That's all we can do, right? We're not here to convince you that you should sell your Tesla. That's not at all what I'm here to do. I'm here just to inform you of, hey, here are some concerns you should be aware of. So therefore, you can make a more informed decision. And at least our LPP team has been absolutely loving these financial flows. I don't know about you guys, but this just makes it so much easier for me to be able to understand what exactly is going on. And I do want to remind you, for those that haven't taken the time, Investing Pro is having a sale right now. You don't have to, but if you like the way that this thing looks and you like to be able to perform a fundamental analysis, this is Investing Pro. It gives you access to Pro Research. It gives you access to Warren AI. It gives you access to Pro Picks. But most importantly for me, it allows you to be able to perform a deeper financial analysis on the stocks that you trade. So if you want to check it out, right now they have a flash sale. It ends in 15 hours. It's 50% off plus my special discount, which is an additional 15% off. You don't have to. Let me remind you, you don't have to purchase this, but if you've been thinking about it, now would be the time with this biggest discount. So it's a total of 65% off. It's the first link in the description of this live stream. So feel free to check it out. You have 15 hours to decide before the price goes back up, okay? 30 minutes after the rate decision, we're gonna have the FOMC press conference. I want to make sure that you are aware of that. We're all good to go live, right? So today is gonna be a longer live stream. So there's the report that comes out in 4 minutes. Are you guys aware of that? And then 30 minutes after, it's the press conference. The press conference is about 30 to 45 minutes long. Do you guys want me to go live for the entire press conference or for at least 30 to 45 minutes? Are we all good? We all good for that? Thumbs up. We have 3,000 of you guys here, yet we only have 200 likes. So you guys let me know what you guys would like to do. Are we good to do it? Yes? All right, let's get the video to at least 1,000 likes. Don't forget, if you want to partake in that live chat, you do have to be subscribed to the channel. So just another reason to subscribe. Can you do it until market close? Hell no. You guys act like this is... No, I mean, I get it. No, I'm not going live until the market closes. I have things to do. I'm happy to go live for you guys here. I went live today earlier for my LPP team. But no, I'm not going live all day. So I go live every single morning right at market open. They're private live streams. You might not even know that, for 30 minutes to an hour every morning. It's how I start my mornings. So if you guys, again, just getting into the market, if you want to get involved, it's the second link in the description down below. I host daily live trading sessions. So you get to see every trade that I take live in real time. All my good trades, all of my bad trades, and we get to start the day off together. So if you want to check it out to learn more about it, second link in the description down below. Feel free to check it out. There is a discount link there for you. You don't have to sign up, but again, I just want you to be aware of it. So QQQ, 2 minutes left. Let's do it. We have 63% of you have responded and said you believe that the market will respond in a bullish way. I agree with you. 63% of you might be asking or saying, Ricky, what? You're a bear. Why do you think markets are going to go up? What do you mean? I mean, it's not rocket science, right? Markets have been more bullish than bearish. It is or does somewhat feel like it could be the buy the rumor, sell the news. But statistically speaking, markets tend to react in a bullish way once the Fed begins to cut rates. And I want to respect that. It's not just my opinion. I don't want my opinion to cloud my way of thinking. I want to look at the numbers, right? I want to make sure the data supports it. And if they do cut rates, especially if they cut rates more than what was expected, you can't be surprised by a rally. Here we go. Really nice push. Oh. Here we go. 1 minute left. You guys ready? What do we have? 30 seconds left. 30 seconds. You guys ready? Hopefully we earn your thumbs up. Please consider subscribing if you guys haven't done so already. And I'm excited to watch the market react to this FOMC rate decision. We have 20 seconds left. 20 seconds. All right. 20 seconds. NASDAQ market trying to run up. 10 seconds left. So do something now or forever hold your peace. A great reminder to manage or mitigate risk before the report comes out if you don't want to be exposed to that volatility. Here it goes. 3, 2, 1. And market's running. Let's see if it continues to run. Market's bullish. Market's bullish. Market's bullish. Strong rally. Strong rally. Strong rally. Looks like it's fading. Looks like it's fading. Huh. Looks a little weak. Let's see how the report came out. You guys ready? Yep, 25 basis point rate cut. Not surprised, right? You guys all knew that it was coming. We all expected it. 4.25 came in as expected. Congratulations, bulls. You guys we got well, you guys got exactly what you were anticipating. Now we watch the market react. This is the part that could surprise a lot of people versus what was expected versus what was reported. If it's as expected, watch markets possibly de-risk. Which one? What do we want to trade? Please do not. Wait. Oh, shoot. What's going on here? What the? Will it let me short? Yep. Dropping. 1,000 shares short. Do not copy this trade. Incredibly risky stock, incredibly volatile. Do not copy it. Just kidding. This thing can literally push up right back to $11 per share in a heartbeat. Don't get it twisted. And I know this, and I know I'm going to regret flexing on you guys because I know this thing can quickly recover. I know it can. Markets are incredibly bullish. They will find any and every reason to rocket. Look at that. Can't be surprised, right? Can't be surprised. A lot of volatility right now. A lot of volatility. I'm glad I I don't even know why I did that. That was definitely like, my thoughts took over there. That was too funny. All right, it's at 10. Old support. Let's see if it gets rejected here. It's still holding right around $10 per share. Not bad. Not a full break-if pattern. This thing can easily run back up to $11 per share. Easily. There's a lot of buying pressure here. Look at this. NASDAQ market. Markets are still up. Look at that volume. Big volume. Who's taking profits or who is buying more? Are you taking profits or are you adding more to your position? Do you think that we're going to rally even higher? Here it goes. Look at open. Open trying to push. There we go. Big push. We hit lows of 947. Here it goes. Watch for the fake out. That's all I have to say. Remember, we still have the press conference. It's hard to remind people what that might look like when there's these strong rallies and there could be just strong rejections right before the press conference. But again, if you like the setup and it meets your criteria and it aligns with everything it is that you're looking for, be my guest, continue to buy at these levels. I hope that it plays out in your favor. I'm here to remind you of obviously what can, not of what needs to be. Here we go. Testing moving average. All right, there we go. Markets, keep it light here. Chipping away, just adding a little bit to it as it slightly gets rejected. Watch for the resistance on QQQ. Do you guys see that? Ignore my trade on open. This is what you should be paying attention to. It's retesting at market open highs. Same resistance range. Let's see if it breaks above. What's the verdict? Did we cut? Yeah. You guys should all have access to this. This is from investing.com. It's free, an economic calendar. We have it for you for techbutsolutions.com/trading tools. FOMC rate decision, 4.25%, expectation 4.25%. Came in as expected. We did cut rates, 25 basis points. Let me update this for you. Excuse me. Is this updating? Oh, here comes the drop. You guys ready for another flex? Oh, PLTR dropping. I'm not happy. I'm not sad to see PLTR drop. I'm excited to see PLTR back at the low 100s. for sure. That's just me. That's my personal opinion, not yours. To the moon, right? For all my bag holders. Just kidding. Not touching open. Good. Open, incredibly risky stock. Insufficient shares available to short it. Will they let me do 50? Too many of you guys are shorting it. I said do not short open. Now I can't short it. I can't add more to it. Now direction is favorable. Let's see how many of you guys are here. Let's see. We got 4,000 of you. There's no way. There's no way. There's no way you guys are shorting it with me. First come, first serve. And all jokes aside, I'm reminding you, please, open is an incredibly risky stock. It's all momentum based. I'm having fun with you guys and I enjoy that. I do appreciate you guys taking time out of your day to tune on into my live stream so we can watch this happen together. Please don't get it twisted. Open is a super risky stock. Please have an exit plan for both best case and worst case scenario. If you've watched my LPP live trading sessions with Open, you know that I'm very mindful of my position size and I keep emphasizing. I know it sounds like a little wussy, right? Of like, oh, why does he keep talking about position size management? Why does he keep talking about how risky it is? Because it is. I treat every stock differently depending on how much or how volatile it tends to be. It's a super volatile stock. I want you to be aware of that, okay? All right. Still forming lower lows. Look at that. Look at that. QQQ. Giving it back. What did we say? What did we say? You can't be surprised in this market full of greed. Buy the rumors, sell the news. There is no way that this thing is about to drop lower. That would be, and I know that's going to piss a bunch of people off. Watch it drop lower. Once it breaks below, where was it? Oh, this is, yeah. So we still have a little ways to go. If it breaks below the price that we were at before the rate decision, watch people take profits. Here it comes. Here it comes. It's going for Tesla too. Look at that. It's happening. Buy the rumors, sell the news. I mean, all the signs were there. I hate to see it for some of you guys because, again, I think it really confuses a lot of beginners. We tried to emphasize it. Obviously, no one knows exactly how the markets are going to react. That would be complete BS if, hey, we knew that this. No, we never know exactly what's going to happen. That's why we talk about risk management, position size management, is because of the uncertainty. But although, however annoying it might sound to you, this is why we do it. Here it goes. It's still holding. There's still no break of pattern yet. It's still holding actually quite well. Okay. Ricky, short. No, I'm not going to short a stock just because you're telling me. What the hell? What the helly? Oof, Crystal. I appreciate you sharing that. I love that. And we're going to hear more about that in today's press conference. So Crystal, and that's what I love to see. People actually doing their due diligence and going beyond, which is what I expect to do after this live stream. Crystal just said in the FOMC rate decision, as it got announced, what was shared was that one Fed member, which wouldn't really surprise me if it was the one that was appointed by Trump, one Fed member said more rate cuts. 6 say no more rate cuts this year so far. That's a big take. That shows that the Fed is being cautious. Watch Trump completely lose his mind off of that sentiment. Remember yesterday he says we need to respect that the Fed is independent, right? We need to respect the Fed's independence. That's what he said yesterday. Let's see if he takes his meds today with what he says. Here we go. A nice drop. So since the rate decision, Open has lost 10% of its value. Look at that. Dropping like a little rock. And look at this. What did we say? What did we say? As soon as it breaks below the support that it had, the price that it had, watch it, cause all of this selling pressure. So unfortunate. No one could have predicted this. This is just a constant theme with the market. And it is annoying. Trust me, I get it. It's super annoying that the market got what it wanted, but then now it's selling off. Make that make sense. Remember, the stock market is a leading indicator. It factors things in advance before they actually happen. So you can't be surprised by this. And again, one moment right now we're retracing. Maybe Jerome Powell will say something in today's Fed conference, press conference, that is incredibly bullish. That is a possibility. But as of right now, it looks like markets are choosing to de-risk. Okay? First move is usually the opposite. It can be. It definitely can be. I love this. I'm going to buy to cover 1,000 shares of open. Nice. We did a good job there. I feel like that was a fair job. Really nice retracement on open. We caught about 6 to 7% of that. There it goes, still dropping. There we go. There we go. We're having conversations right now within our LPP team. Just a great reminder, take profits when it makes sense to you. Never be, what did we say? And I saw that there was someone sharing something in the live chat saying, oh no, markets are dropping. I'm still up X amount. No one's asking how much you're up, buddy. Like, if you have to cope that way, that you have to express how much you're up, it just shows how weak and uncertain you must feel right now. No one cares how much you're up, right? We want to see you all win. And if you decide to hold a position longer than you anticipated, and now you're losing a little bit of money, remember, that's the position that you put yourself in, right? Cope harder. It's no one's calling you out for anything. It's you get in, get out, make your money and bounce. And if you decide to hold a little bit longer, that's on you. It's not that deep, right? No one wants to see you lose. No one cares enough, right? The market's not against you, it's you. It's if you should have seen that it was overbought, and it's just right now. Right now, open is selling off, but who knows? Maybe by the time that Jerome Powell begins to speak, it will go in your favor. I just don't like seeing things where you have to be snarky. Even with my winning trade right now on open, I don't care to put someone down, right? I truly do not believe that me making this money is taken away from you. You could have done your part in taking profits up here, right? And just like I'm taking profits here, then maybe I can go long on open. Who knows, right? It doesn't have to be an exchange between you and I. I'm not against you. I don't even know who you are or that you even existed. I want to remind you of that. It's not you against I, it's you against the market. Either you work with it or it works against you. So, okay. There it goes. Oh, shoot. Oh, shoot. Oh, shoot. Oh, just a reminder, take profits when it makes sense to you. Take profits when it makes sense to you. Holy smokes. How much has this thing lost? It's lost 14%. It was up 20% on the day. It was up 20%. Ouch. Again, with great volatility comes great responsibility. Let me make this clear. It is not your money until you take profits. So even if you're up a little bit on your short, I want to remind you, it's not your money until you take it. Close it out. When in doubt, close out. I want to see you win because you earn it, not because you feel like you deserve it. You don't deserve shit in this market. Get that through your head. Nothing. You don't deserve anything. I don't care where you come from. We all have the same opportunity here. You learn from your mistakes. You become familiar with what works, what doesn't for you, and you scale accordingly. That's it. Let's not make it deeper than what it is. I want to see you guys win because you earn it, not because you feel like you deserve it. There it goes. PLTR, watch out for a potential support. It looks like it might be finding its support range. Respect the trend. Here it goes. Ricky, $5,000 profit on open, and I'm all out. Jorge, I love to see you win, brother. I love to see you win because you earned it. Happy to see you taking profits on an incredibly risky stock. I hope that you took this trade because it made sense to you, not just because I took it, right? And it looks like you decided to take profits when it made sense to you. Love to see it, brother. $300 profit. You guys don't have to thank me. I didn't take the trade for you, right? I'm happy to see you guys win. Now just be mindful. In 13 minutes, it can be a complete shift. I'm repeating the same thing over and over again because I need to drill it through your head. Just like the people that felt like they were on top of the world when it pushed up, they don't feel so on top of the world right now, and vice versa. It could be the exact opposite. If you hold that position too long and markets begin to skyrocket, that is a possibility, right? Markets are incredibly volatile. They're selling off a little bit right now. They can rocket if Jerome Powell says something. I'm not saying that they will. I'm saying that they can. So do something about it if you don't want to be exposed to that volatility, okay? Okay. Man, you guys made more money than I did. What the hell? What the hell? All right, we got 12 minutes until the FOMC press conference. I have it here. Are we all good to go live for that press conference? We're all good for that? You guys would be happy for me to go live? So I have 5,000 of you guys here, yet I don't think you're all subscribed to the channel. I don't know. We're all good? No live. All right. No live. Wow. What a beauty. What an absolute beauty. Let's see. Just for funsies, does it let me? No, I shouldn't. Just for fun. Does it let me add more to my short? No, it doesn't. It doesn't let me even add 50 shares. There are insufficient shares of this stock available to borrow. You guys fully took my ability to short this stock. You guys, I'm not touching the stock. Let the chaos pass. I like that. I really do respect that. And some people are going to call you boring. Some people are going to try to encourage you to jump in. Remember, you're in full control of what you decide to trade, right? So I'm very happy to see that you can, control your emotions, stay cool, calm, and collected. Very happy to see it. I think it says a lot about your character. It will be funny when taking screenshots get spanked in 10 minutes. LOL. I don't know who's we're taking profits, brother. There ain't no screenshots here. We're here to take profits. Again, co-partner. It's sad to see that you get so offended by seeing other people win. Sad day. Will it let me short now? Nope. Still not. 500. It doesn't let me short. What else is there available to trade? What has good risk to reward? Well, right now it's pretty crazy, right? Because the markets are either oversold or overbought based off of what they just reacted to. And then you have to guess where you think it's going to go. Is it going to continue to drop, or is it going to bottom and begin to recover? And then this is where it makes more sense for me to just stay cash, right? Just watching, like you said. That's fine. I like that. Not ready for this. And I think that's important for you to be able to be self-aware to know, right? Happy to see. All right, we got 9 minutes. Watch for a possible reversal here. Early stages of a possible reversal. Yep. Here we go. Buy to cover. I'm going to risk it. Do not copy this trade. I'm going to go long. I'm going to go long on open, 500 shares. Incredibly risky setup, but it looks like NASDAQ market is beginning to pick up. $2,500 shares. Again, keeping the position small, still right around $30,000. Okay, NASDAQ trying to recover. Do you guys see that? NASDAQ trying to find its support, testing that moving average and that EMA. We'll see if we pop through and begin to rock it, or if it gets rejected and forms a lower high. Both easy possibilities right now. Too many ads. I'll remove the ads for you. Don't mean to get you with all the ads. I had the ads set to low, but I'll take them off fully right now. You guys can feel free to refresh your screen, and there should be no more ads. Okay. Love this price action though. I agree. It's really cool to see, right? The price action, the downside, the recovery, testing a critical range. We'll see if we break above. Looks like NASDAQ. Looks like it broke above that EMA. Let's see if the price action continues. All right. Watch for a resistance. NASDAQ showing slight signs of a resistance. You see this? Watch for a leg down. Be careful. Again, we're always talking about both sides. Nice push. Here we go. I'm going to buy another 1,000 shares to go long on open. Please do not copy this incredibly risky trade. Okay? Only Miran, Trump's appointee, voted for a half cut. Does that surprise us? No, right? Don't like how slow it's been. Nope. I'm fully closing out. I know Oh, whoa. I did not fully close out. I sold 400, not 4,000. Fully closing out now. Why am I fully closing out? I don't like that NASDAQ market's showing signs of a rejection here. So possible lower high, that means another possible leg down. So what that means is I have 5 minutes left. I'm just going to take a small little short on Tesla, 100 shares. I'm going to keep it light, just for fun. Very little trade, possible risk to reward, very small trade here. Okay. Here we go. This is the setup. All right. What is the difference between Investing Pro and the LPP? Investing Pro is just the software that I use. If you've watched any of my videos, I'm sure you've become familiar with it. And let me make this clear. The link that I share with you guys is an affiliate link. So I do get a small commission. I earn like an affiliate commission when you guys use my link. But I like to be straight up with you guys. I do use this software literally every day when I do a fundamental analysis. You guys know that I don't really promote things that I don't actually use. This is something that allows me to kind of dive a little bit deeper into the companies that I'm considering investing or trading. With my discount link, you not only get a discount, but like right now, there's an additional 50% off. So it would be one of the better times to sign up if you wanted access to Investing Pro. That's all. That's what Investing Pro is. It allows you to use Warren AI, do a deeper dive into these companies. It gives you access to these pro research, which are, again, for me, they're very visually appealing and they make it easier to kind of digest how these companies are actually performing. Not just the hype that the charts show you, but how the companies are actually performing. So that is what Investing Pro is. And it offers a lot more, right? They have pro AI picks, they have screeners, data explorers, they have, a handful of different things. This is what I mainly use it for. So if you want access to it, they have a sale going on and it's for the next 15 hours, 14 hours. So you can check it out. If you like it, great. And if not, I respect it, right? I'm not here to convince you to do it if you don't like it, but it's the first link in the description down below. LPP is for those that want to watch me trade live every day. So it's a one-time payment, lifetime access, and you get access to me, the LPP lesson library, and the daily live sessions. Two very completely different things. Investing Pro is a software. LPP is to get access to my live sessions. So I hope that makes sense. So Ricky, you promoted Moomoo and you don't use it. Moomoo is actually a company that I'm working closer with to work with them on developing their platform. So I actually do use it. I'm working with them to make it something that's more suitable for me and what I would assume my audience would also like as well. So again, if it's not something that I'm okay with, then it's something that I work with them on to make it more applicable for myself and the other people's that follow me. So I've always been very straight up with you guys. So yeah. Ricky hates Tesla. Nope. I love Elon. I think he's one of the greatest minds of our generation. And I own 2 Teslas myself, two of the most expensive Teslas. I own a Tesla Cybertruck, which is great at depreciating, and I love it though. And then a Tesla Model X. I also have an allocation for a Tesla Roadster that I made over 6 years ago. So remember, I'm okay with, talking about the bad, even with the things that I do like. That's the whole point of, I would say, having an opinion. Is in today's world, you have to agree with something 100% or you're against the movement. It's insane to me. You don't even agree with your partner on 100% of the things that they decide to do. Yet you're going to agree with strangers? It's like, come on. Be a real person. All right. Press conference. We are live. Sit back, relax. I hope you enjoy. And let's see how the markets react. Here it goes, JP.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the market slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country.
What the?
To achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
All right, here we go.
Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
And then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. But what we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when we feel that policy is a place and needs to move quickly to place. That's not at all. Wait and see.
Translation, lucky that you got 25 basis point rate cut. Is it just me that
And
in place? In place. I guess I'm just, trying to square the shift in the rate in just 3 months ago with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP,
I apologize, guys. I don't know what's going on. If it's just on this site. Let me get off the site.
In place. I guess I'm just, trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low, it's still a relatively low rate, but we're seeing downside risks.
Sorry about that, guys.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
I think a follow-up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame,
NASDAQ
2%
market
inflation
dropping.
and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that though, right? We have to, our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on, the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you gotta be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So
another leg down.
But we get together, we discuss. We have a great discussion, and then we decide what to do, and we act. But you're right, it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just, everybody who is at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and people they're making their arguments, and we're having a great discussion around these challenging issues. So.
Do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
I like that.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies, and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
I like that. Why can't every politician?
Thanks, Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. A black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a 0.25 percentage point now is going to arrest that?
Well, I didn't say that I thought a 0.25 point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minority unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Bank system, Federal Reserve system, and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
Not an independent review?
We're certainly open to to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other
watch for a bull trap on the NASDAQ market.
At a college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of, the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, if that's in the DNA of the institution, that's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow-up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity.
Testing same overbought resistance for QQQ. Just a quick little heads up.
Like consumption was stronger than expected. What we got earlier this week.
Same thing for Tesla.
And also we're getting
beautiful
a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply, and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up, during the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times. And as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
Testing same resistance.
So, we're aware of that. I think this default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices, so that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities, and I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run, they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter term inflation expectations have tended to respond to near term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer term inflation expectations both break even in the markets, and almost all of the longer term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. We're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates.
Thank you.
Thanks very much.
There you have it. 45 minutes, 50 minutes for JP. Can you guys hear me and see me okay? That was kind of long, but it had to happen. So biggest takeaway so far when it comes down to the FOMC rate decision, from where we started to where we peaked at to what we hit lows of to now where we're at right now. Markets tend to be or are showing to be at a previous resistance range. It doesn't mean that it has to get rejected here. It just means that it's approaching a previous range where it did get rejected. If there's enough momentum, it could break above and continue to rally into the close. There's about 30 minutes left in the market. So again, you can't be surprised by this irrational market. Biggest takeaway is that the Fed cut rates 25 basis points as expected. They're still taking things meeting by meeting, and he made sure that he did not go beyond answering any questions that he shouldn't have as the head of the Federal Reserve. I truly wish more politicians were like this. He is single-handedly just focused on doing his job. You don't have to agree with how he's doing it. At the end of the day, your opinions are relevant about when it comes down to it. They're independent. He stays the course. He's made it very clear that he has been data dependent, and that's it. They decided to cut rates because of the slowdown in the labor market, and it was to appease that slowdown, and they'll see how things continue to go meeting by meeting. Also, a big takeaway is kind of the split that we have right now in the market. There's about 10 members that said that they would be open to cutting rates again by the end of 2025, and there are some 9 members that said they wouldn't be. But remember, these members rotate every single meeting, and there's about 12 members that vote. There is one member that was, and this was the first time that they have voted, that was nominated by Trump and who is also part of the Trump administration. In my opinion, that's a direct conflict of interest. I do believe that although Jerome Powell didn't want to comment on it because he doesn't like to comment on anything that has to do with politics, it's not rocket science. He's part of the Trump administration. Obviously, if he's also part of the Fed, it is a direct conflict of interest and does really question the independence of the Federal Reserve. Nonetheless, what Jerome Powell said was made very clear. Not one single member will overall dictate what the 12 members vote on, since it's always revolving. So I thought it was a good FOMC meeting. Now we just wait for the market to really digest what was said and how markets continue to react. One moment we're selling off, another moment we're pushing up. We'll see how they continue to close. And again, I do want to remind you, you do not have to, but if you want to take advantage of this flash sale for Investing Pro, it's the first link in the description down below. You will get 50% off on Investing Pro, plus a special discount, which will be an additional 15% off if you use promo code Ricky. It's the first link in the description down below. You don't have to sign up, but that is if you want access to Investing Pro and all it has access to. Also, if you want to watch me trade live starting tomorrow, that's that second link in the description down below. You can sign up today and watch me trade live starting tomorrow right at market open. I appreciate you guys' time. Thank you guys again so much for tuning on in. I hope they're into thumbs up. Please consider subscribing. And like always, let's make sure that we end the year on a green note. Take care, team.